Welcome, ladies and gentlemen. Our event will begin momentarily. Please note that this session will be recorded for informational, educational, and marketing purposes. Good morning, afternoon, and evening, whenever you are. On behalf of Nanyang Business School NBS, United Nations Supported Principles for Responsible Investment, PRI, and European Corporate Governance Institute, ECGI, I'm delighted to welcome you all to the third lecture of the NBS-PRI-ECGI Popular Lecture Series on Sustainable Business. My name is Yusha Zhou, and I'm assistant professor here at Nanyang Business School at NTU Singapore. I have the privilege of representing the organization committee as your MC for today. The NBS-PRI-ECGI Popular Lecture Series is a brand new global initiative starting this year. This aims to facilitate knowledge exchanges among academics, practitioners, and policymakers in the field of sustainable business. Every month, we host a public lecture, either in person at NBS with live stream through Zoom or virtually via Zoom. Each lecture features a leading scholar who presents an overview of academic research focusing on a specific topic in sustainable business, and an industry expert to moderate the Q&A session to connect academic insights with practical experience. After each event, we summarize the content in a blog post to be shared together with the lecture recording online to create a public library for sustainable business for everyone. This year, we have an exceptional lineup with renowned academics across various disciplines, including economics, finance, accounting, strategy, and law, aiming to encourage interdisciplinary collaborations and dialogues to address sustainable business with a more holistic perspective. In the first two lectures of this series, we started with an inaugural lecture by Professor Laura Starks from the University of Austin, delivered in hybrid mode in NBS Gaia on climate risk and financial markets, value versus values perspectives. This was moderated by Dr. Joanne Q, the ESG director from Eastspring Investments. Very recently, Professor Pedro Matos gave us the second lecture online on ESG investing and green transition, which was moderated by Stephen Beer from LGIM. If you would like to catch up on our previous lectures, please feel free to check out our recordings on YouTube and also online blogs. So today, we're going to look at sustainable business and investments from a new perspective, led by Associate Professor Madison Condon from Boston University School of Law. Currently, Professor Madison also sits on PRI Academic Advisory Committee and is a contributor to ECGI blogs. Professor Madison is an expert on climate change, financial risk, and regulation. Her research is listed among the collections of the best articles in environmental law, corporate law, and securities law. Her work has also made a real-world impact and was referred to by regulators such as U.S. Securities Exchange Commission, SEC, and U.S. Department of Labor in their rulemaking. So today, Professor Madison will deliver to us a public lecture on a very interesting topic called Universal Ownership, Systematic Stewardship, whatever you call it, where do we stand? So following the lecture, we'll have a 30-minute Q&A session. Some of you have already shared with us some interesting questions upon registration, which was greatly appreciated. If you have any questions during the lecture, please post them in the Q&A function on Zoom, and our moderator will try to address as many questions as possible during the Q&A. So now, Madison, the virtual floor is yours.
Okay, thank you so much, Yusha. I'm going to share my screen. How does that work? Can people see my screen?
Yes, all good.
Cool. Great. Okay, so thank you so much for having me, Yusha for hosting me, and for Nanyang for hosting me, and PRI for helping organize this along with ECGI. Thank you to David for being my commentator. I'm very happy to be here. and share with you this talk, Universal Ownership, Systematic Stewardship, whatever you call it, where do we stand? And this talk is in part, it's a follow-up on a paper that I wrote in 2020 called Externalities in the Common Owner, which basically argued in favor of a universal ownership approach to institutional investor engagement on climate change. It argued that institutional investors have a financial incentive to internalize externalities and diminish systemic risk at the portfolio level, even if this might mean forcing individual firms to sacrifice profits, such as oil and gas companies. It raised potential legal dilemmas, including antitrust and fiduciary duties of both boards, corporate boards and fund managers. And whether investors can and should do this, should behave as universal owners, has become a matter of great legal and political and practical debate. Can I change my slides? So the critiques of the universal owner framing, there are several, and I've grouped them into 4 rough categories. One is that the economics of emissions reductions don't actually work out, meaning it wouldn't work out, meaning it's not actually worth it to universal investors to work to decarbonize their portfolios, given the long-term costs of climate change. The second is that it's perhaps illegal for corporate boards and/or investors to do this, including concerns about antitrust allegations and fiduciary duties at both the corporate level and the fund level. The third argument is that it's not possible for investors to really have a real-world influence on decarbonization. And the fourth are concerns about agency costs, meaning, even if asset owners, so pension funds and endowments, wanted to decarbonize portfolios and it would be worth it in the long term for them to do it, they are unable to force the asset managers, their clients, to actually effectuate their desires due to agency costs. So I'm going to address some of each of these concerns, beginning with the first one. I'm going to spend a substantial amount of time on this first issue of climate economics for a few reasons. One, because it's a focus of recent work of mine. It's a subject of more recent research of mine, and I think it's very important. But I will also talk about the other issues as well. And despite these critiques, there's nevertheless growing calls for institutional investors to pursue universal ownership or systematic stewardship or systemic stewardship across their portfolios. This is a report from several years ago from the UN-convened Net Zero Asset Owner Alliance, and they are calling for asset owners to demand bold climate action from asset managers. And they cite a piece by Jeffrey Gordon, who's a professor at Columbia Law School, who, similarly to my paper, argues that universal owners have a portfolio-wide objective to maximize returns at the portfolio level rather than necessarily an individual firm-specific profit-maximizing mandate. So let's dive into issue number 1, which is an issue very close to my heart. Climate cost-benefit analysis. The main point is that mainstream economic models have grossly underestimated the macroeconomic costs of climate change. And for research on this, I'm going to talk about some highlights, but if you're interested, on the right-hand side of the screen is a blog post that I wrote in 2023, critiquing one of the leading climate economic models called DICE, which is a model produced by William Nordhaus, for which he won the Nobel Prize in 2019. And then a much longer paper that came out, 2025 is wrong, it actually came out in 2023, but it's, oh no, sorry. A paper that came out just earlier this year about scenario analysis, which is sort of my surveying more recent innovations and proposing a better methodological approach to estimating climate damages than some of the leading macroeconomic neoclassical economic models. So I'll talk about, I can't go into all of the details of the methodological challenges with estimating climate damages, but I'm going to try to give some highlights so you might get a sense of sort of where the field is at. So I'm not the only one who is very critical of the leading mainstream macroeconomic models of climate damages. There's been a spate of recent research pointing out major failures in economic models, including this piece from Carbon Tracker, which is in the middle of the screen, which criticizes the models used by investment consultants in advising pension funds in the UK as to the cost of physical climate damage. And they, sort of similar to my blog post, really critique this DICE model produced by William Nordhaus. And another paper that came out, I think a couple years ago at this point, is on the left-hand side of the screen. It's a partnership between the University of Exeter and the Institute and Faculty of Actuaries, which is the professional association of actuaries in the UK. This paper called The Emperor's New Climate Scenarios. They're also very critical of sort of the gross underestimates of macroeconomic climate damages. And they propose an alternative methodology, which produces an estimate of 50% global GDP loss sometime between 2060 and 2070. So losing half of global GDP is a much higher estimate than we've seen from the leading macroeconomic neoclassical damage function models. So I'm going to dive into, so what's wrong with these models? What's wrong with DICE, which has been used by Mercer, for example, the investment consultant in advising UK pension funds. Just some highlights of some problems with DICE. It leaves out huge categories of damages, and it has a very hard time of dealing with uncertainty, climate tipping points, geographic heterogeneity, and tail risk, extreme event risk. It simply assumes a quadratic relationship between emissions and climate damages, which is, I think, an unrealistic assumption. And this is the model that Nordhaus won the Nobel Prize for in 2018. So let me tell you a little bit more about the challenges with DICE. So part of the challenge with getting the economics of climate change correct is it's hard to meet. It's really important, and a thing that economists have really struggled to do is to meet the climate science where it is and to understand what exactly global climate models are able to tell us about what the future of what the future of the Earth will look like under climate change. So just a very brief summary of what climate models are able to tell us. So global climate models, GCMs, are incredibly resource-intensive models. They require large teams of climate scientists to build, and they are run on the world's largest supercomputers. They are only owned and maintained by governments. There are no private sector global climate models. The United States has 3, for example. I believe the EU has 2. And they model the interaction between the Earth's atmosphere and the oceans under different concentrations of CO2. And they output information on a 60 by 60 mile grid. So this is not totally to scale, but in this image, each of these little cubes are supposed to represent 60 by 60 by 60 miles cubes. And that is sort of the data output that the global climate model is able to produce. Which means that if you're interested in risks that are happening at a geographic granularity that is smaller than 60 by 60 by 60 miles, you're going to have to do some other methodological, downscaling is one of them, but some other methodological investigation to try to figure out what might actually be happening at the city level or an asset level. Most importantly, the most important thing to understand about global climate models is that they are climate models, not weather models. And climate is sort of definitionally the average weather. So they are designed to predict averages, not extremes. And it turns out, if you're thinking about economic risk or financial risk, extremes really matter. The 1 in 1,000 chance that you break a crucial piece of infrastructure, for example, climate models are not necessarily great at capturing the statistical likelihood of extremes. One, because of sort of the averaging over these geographic grids, but also they take a ton of computational power to run these models. And so you're limited in the amount of simulations you can run to try to get sort of the multiplicity of possible events that could ever happen. So you're limited in sort of how you can construct a distribution of potential events in various geographical locations, just because these models take a very long time to run. So because of these computational limitations, this is sort of a high-level summary of what they're good at and bad at. They're very good at thermodynamics, meaning global climate models historically have been very good at predicting average global temperature rise given a certain concentration of CO2 in the atmosphere. They're limited at dynamic, what scientists call dynamics, meaning localized weather in general, especially extremes like heat waves and extreme precipitation. They're not necessarily great at predicting very complex tipping points. For example, the Atlantic Meridional Oscillation circulation shutdown, which has been in the news a lot lately. The ocean currents in the North Atlantic, there's concern that as the ocean temperatures heat up, the ocean currents might start breaking down, which could lead to ice ages in Europe and potentially the United States. They're not super great at pinpointing like when that could occur or if it could occur. And they're not great at carbon feedback loops. They're not good at all for certain other tipping points like ice sheet collapse, compound hazards and events, meaning, again, this is because of the limitations of sort of the statistical, trying to build out the statistical distribution. They're not great at trying to predict like an extreme rainfall followed by a prolonged drought. How likely would that occur? And very importantly, they're not good at predicting things that are simply not in the model, meaning climate change's impacts on groundwater levels. There's no groundwater in the model. Relatedly, like you can't just sort of take the outputs of a global climate model and understand anything about wildfire risk because there's no trees in the model. So adaptation scientists who are interested in things like wildfires have to build their own more granular models that include trees, that incorporate outputs of the GCM, so predictions of average global temperature and precipitation, but then input it into their own model sort of that includes trees. But most economic models, including those surveyed by the IPCC and DICE, for example, which is used widely by investment consultants, simply take the average temperature output of the global climate models and then input that into their economic model. And that's a huge limitation of the leading economic approaches. And the challenge really is how to integrate the mounting adaptation science, which is a very diverse range of scientists working very granularly in different climate change impacts together to get a better description of the future. So just to illustrate, and if you're interested in this, there's really this is a very complex area of research. Obviously, if you're interested, this paper came out a couple years ago called Climate Services, the Business of Physical Risk, in which I really dive into the details of how these models work and suggest improvements, including borrowing from the insurance industry's use of catastrophe models, which are useful for exploring tail risks in particular. Okay, but so just to further illustrate the remaining challenges, even as macroeconomists around the world have come to agree with my position in recent years and have adopted new approaches to get over the limitations of DICE, for example, and similar integrated assessment models. This Asian Development Bank came out in the fall with this headline finding of 17% GDP loss for the Asia-Pacific region in 2070. So my initial reaction upon seeing this headline was sort of like, okay, 17% GDP loss in 2070, that is more order of magnitude in line with how I expect the economy to react under extreme physical risk events. It sort of makes sense, with my understanding of how climate change might unfold in the future. It seems like there's going to be a lot of economic impacts. 17% seems more in line than, say, the 5% predicted by some of the leading macroeconomic models. But let's actually look at the model that they use. So there's a lot going on in this slide, but this is the Asian Development Bank's model that they use to find this 17% GDP loss figure. And so you can sort of ignore the right-hand side of the screen. That's really the economic model, which is representing spillovers between households and firms, and global banks. And I don't really have a lot to say about sort of the economic model. I'm more interested in the left-hand side of the screen about the climate impacts that they do identify. So one thing to say is I actually think this methodology is a significant improvement over sort of the DICE models of the past, meaning they're not simply taking average global temperature rise from the global economic from the climate models and then feeding that into the economic model. They have actually relied on impact scientists, so scientists working downstream of the global climate models on specific impacts like sea level rise, for example, or floods, and feeding those more granular impacts into the economic model. So that's all good. I think that is a significant improvement over past approaches. But if you look at the impacts that they've actually fed into the model, they're pretty limited. So they've looked at sea level rise impacts, flooding impacts on capital stock, labor shocks on sectoral labor productivity, mostly from heat waves and heat extremes, and forestry shocks. And my critique is that that's a pretty limited set of impacts, actually, given what we know from the global climate models. So all I had to do was sort of look at this and say, I wonder why they didn't consider lack of freshwater availability in the Asia-Pacific region. And just to illustrate my concern, this paper came out a few years ago. It's co-authored by a leading climate scientist named Michael Mann. And this is about freshwater storage in the Tibetan Plateau. And as you can see in the slide, the Tibetan Plateau supplies a substantial portion of the water demand for almost 2 billion people. And this paper finds that in a business as usual scenario, where we fail to meaningfully curtail fossil fuel burning, we can expect a substantial, that is nearly 100% loss of water availability to downstream regions of the Tibetan Plateau. So a lot of people in this region illustrated on this slide, so we're talking like much of India, relies on glacier melt that is stored in the Tibetan Plateau for drinking water and irrigation. And so one thing to note, this is not a high emission scenario. This is not RCP 8.5, if you know what that is. My reading of this science is that this almost certainly will happen devastatingly, sort of regardless of what our emissions path is at this point. The second thing to note, and why I'm really fixated on this example in particular, is that the scientific processes behind this impact are relatively simple. The process is that ice melts when it's hot. And I say that because there's been a lot of attention lately on certain catastrophic Earth system tipping points like the AMOC collapse. But the processes behind the AMOC collapse are deeply complex, and there's a lot of uncertainty around them. It's felt lately like for every paper that says a collapse of the AMOC is imminent and we should all be freaking out, there's like another scientific paper that says, actually, it won't happen for 200 years and it's sort of far away. So there's a ton of scientific debate over when exactly an AMOC collapse could happen. But this, there are a lot of other processes, mainly hydrological processes, that the global climate models are much able, there's a lot less scientific uncertainty over the likelihood that they will occur, given what we do know from global climate models. And importantly, going back to the Asian Development Bank's model, these processes, even that we have a lot of certainty over, tend not to be represented in economic estimates of global climate damages. So I've taken you on a long survey of climate science to get you to my legal point, which is, what duties do pension fund trustees owe 2070 retirees now? So these people exist. My retirement fund has a target date of 2050. I have students who are much younger than me. These are not like hypothetical people. There are people existing in the world who will retire in 2060 and beyond. And I think, frankly, there's no simple answer to that. If you take seriously that damages are going to be on the order of magnitude of half of global GDP, I think we need to be more creative about exactly how pension funds and endowments fulfill their mandate to long-term retirees now. And in particular, I think we need to take the duty of impartiality, which is also known as the fiduciary duty of equal treatment, more seriously. And this duty holds that you can't preference people retiring in the near term over those retiring farther in the future. And yet I would argue we absolutely are doing that. And I can imagine successful lawsuits in this arena against pension funds as the economic modeling develops into the type of economic finding that a court could really hold on to and sort of agree with a potential plaintiff that they are being disadvantaged by the way pension funds are being managed in the present. And I could imagine a successful lawsuit against pension funds in the future under this type of claim. So, and again, I think there's no easy answers. I think that if we are definitely going to lose that amount of global wealth, I think we have to start thinking more creatively about how to mitigate the loss now, potentially including considering other asset classes and potentially investing in sort of adaptation measures at a local level. So that's some food for thought. All right, moving on to other concerns about universal ownership. I'm going to combine critiques number 2 and number 3 here, which are concerns about the legality of systematic stewardship or universal ownership, as well as the ability of universal owners or diversified investors to actually impact decarbonization in the real world. So a recent Delaware court decision in McRitchie versus Zuckerberg that happened this past year rejected plaintiffs' claim that corporate directors owe fiduciary duties to diversified shareholders, and the court emphasized that director duties flow to maximizing profits in an individual firm. And the allegation in this case was that Zuckerberg and the board of Meta had managed Facebook in such a way as to generate harmful externalities in the form of social media addiction and disinformation that had harmed macroeconomically the broader portfolio of diversified investors, and they made a fiduciary duty claim at the corporate board level against Meta's board. They lost. So there's been a lot of debate over what this means for universal ownership for climate change. I think what I would just emphasize is that the business, and I understand that this is a US case, but certainly in the UK, but also in Europe, I don't think that this court was necessarily saying anything like radically new about how one interprets fiduciary duties at the corporate level. In general, corporate boards owe a duty to maximizing the profit of the individual corporation. Nevertheless, the business judgment rule remains, meaning there's strong judicial deference to director business decisions, and courts are not particularly interested in probing into why, for example, Microsoft spends a great deal of money on carbon capture projects. So long as there is a plausible business purpose, Microsoft board is fully free to spend a significant amount of Microsoft revenues on decarbonization initiatives. Even though it's sort of orthogonal to their main mission of selling software, there are certainly many plausible reasons why Microsoft might want to invest in decarbonization initiatives for the long-term returns of Microsoft. So courts are not going to be aggressively digging into the motivations of the Microsoft board for doing this. So that means investors still have a lot of power, I would argue, in terms of influencing who sits on the board and how those investors sitting on the board think about the inevitability of the green transition or the pace of the green transition. And so these images on the right-hand side of the screen are from BlackRock marketing material from a couple of years ago. But I think their terminology is sort of useful for illustrating the point that I'm trying to make. So BlackRock gives investors an option. They can either navigate or drive the transition. And navigating the transition means simply investing along the most likely decarbonization path. BlackRock's sort of like, we're in the transition is happening. The real question of relevance for investors is how fast it will happen. Are you just trying to sort of anticipate the most likely decarbonization scenario? Or are you actually trying to drive the transition, meaning make, advance decarbonization, use your resources to push decarbonization in the real world? So navigating is one way to think about it, is their option to navigate the transition is simply investing along this like sort of most likely pathway. So either the orange or the yellow line. And so not a particularly climate ambitious investor would invest along this yellow path, while a climate motivated investor would invest along this green path, for example. And this sort of implies, and this is where I'm getting to my main argument in this section, that the more investors believe the transition is in fact happening, meaning the more investors believe that the most likely emission scenario is going to be closer to the green line than the yellow line, the more reality starts to resemble the green line rather than the yellow line. So finance is sort of a self-fulfilling prophecy in this way. The more that the global investor community believes in the inevitability of transition, the more they're going to align their own portfolio investments along this expected inevitability of the green transition, the more the green transition actually occurs. So another way to say this is like, what type of emissions reductions should a firm rationally undertake in response to everyone else's net zero goals? So I'll say a little bit more about that in a couple slides. So how fast will we transition? This is really the million-dollar question. So far, I would just highlight that so far the conversation about corporate decarbonization has mostly focused on fossil producers, at least in the universal owner literature. But really the success of the transition is going to hinge on the demand side, I would argue, not the supply side. So, as I think the numbers coming out of China about electric vehicle sales, not only in China, but the markets that China exports to are quite impressive. They're kind of crazy, sort of like 65% of recent sales are going to electric vehicles. That is obviously going to have an impact on global oil demand. So the demand side is extremely important as we sort of estimate where we're going in the green transition. And the most interesting investor decarbonization initiatives in my mind are cross-sectoral initiatives. They sort of recognize the supply and demand needs to move in tandem across the economy. So it's not going to be useful if you just turn off oil and gas supply without working to decarbonize the demand side simultaneously, or else you're going to create shocks and price spikes, whatever. And this recognizes that oil and gas demand in large part depends on what happens to the high emission sectors, including aviation and industrial processes. So there's been a recent focus on the hard to abate industries, and sectoral decarbonization pathways have been built or in the process of being constructed for steel, aviation, shipping, trucking, aluminum, chemicals, and buildings. And so that's my next slide. The idea here is like, so the use of scenario analysis as a tool for investors to analyze corporate transition risk has a long history in the oil and gas industry. For example, there was a successful shareholder vote against ExxonMobil asking Exxon to release an audited report of how its business would fare under certain emissions reduction scenarios. And what I think is one like potentially successful way forward is for investors to take these scenario analysis exercises and have them be granularly constructed for sector-specific industries, and sort of similarly ask corporations to analyze their business models alignment under these sectoral specific scenario decarbonization pathways. And I think these decarbonization scenarios are going to play a more crucial role going forward. I think so one way of saying this is, I think, so the Science-Based Targets Initiative, for example, it's really hard to analyze the greenness of any corporation like in isolation from its supply chain peers. Meaning, if you're going to decarbonize the steel industry, you really need to understand like, where is the steel industry going to get its electricity and energy inputs from? What do they need farther up and down the supply chain in order to make that decarbonization happen? And these scenarios are pretty detailed. Some projects include like every steel plant in the world and what that steel plant would need to do in order to get on a net zero pathway. And that information can then feed into portfolio-wide understandings of fossil demand. Meaning, if you start having all of the heavy industry corporations in your portfolio start to decarbonize, that suggests to you as a diversified owner that oil and gas demand will be muted as the rest of the companies in your portfolio are starting to rapidly decarbonize. So one example of supply chain decarbonization that I think is worth noting, because I think it's pretty interesting, is the First Movers Coalition. It's an example of cross-industry and supply chain collaboration, and it includes partners such as Amazon, Maersk, Ford, Apple, FedEx, Delta, Microsoft, Apple, Nokia, PwC, and Salesforce. And the idea is that, and this was an initiative by John Kerry, sort of the future of this initiative is a big question mark, I would say, given the recent political changes in America. But the idea is that to jumpstart the market, the coalition's members commit in advance to purchasing a proportion of the industrial materials and long-distance transportation they need from suppliers using near zero or zero carbon solutions, despite the premium cost. So the idea is that Amazon is going to pledge to use zero carbon shipping from Maersk, which is then going to pledge to buy green steel for their boats, which is then going to, so it's the idea is that you sort of get everyone in the portfolio to commit to purchasing net zero material and integrating net zero processes into their supply chain simultaneously across the supply chain. And in doing so, the First Movers Coalition is endeavoring to further ensure the development of key technologies and power our near net zero future for years to come. So one thing to say, so this initiative is a few years old. This is just to emphasize, so I think this is not my idea, this is, I think, increasingly clear to everyone that works in the climate space that the demand story is really an enormous story. So this image I think is worth spending some time on. These are the historical demand forecasts made by one of the electricity transmission organizations within the United States. So it's PJM, which is the transmission grid that encompasses the mid-Atlantic states, including New Jersey and Virginia and Pennsylvania. And I find this image pretty incredible. So these are the demand forecasts in megawatts that were made in 2016, 2017, 2018, 2021. You can see that until the last few years, long-term demand projections for electricity weren't so different from one another. They sort of just extended the present day trend line farther out into the future to the 2040s. Starting in 2024 and then exploding in 2025, all of a sudden demand projections just went through the roof. So now the most recent demand projection, the one that was forecast this year, says actually in 2040, we're going to need orders of magnitude more electric power in this region. And the story here is mainly AI-driven computing demand, which suggests to me that these emission scenarios and investor advocacy really need to start thinking about what they can do to limit demand growth on the AI side, I would argue. Okay. Okay, which then leads me to antitrust concerns. So these supply chain collaborations, these sort of like portfolio-wide perspectives about how corporations should all work together in order to simultaneously decarbonize their portfolios. They raise antitrust concerns, which I'm not going to spend a ton of time on, mainly for a couple of reasons. One, I'm not really an antitrust scholar. And also, I think this is really an America-specific issue as far as I can tell so far. And at least in the United States, I think that the antitrust concerns should in fact be taken seriously, even if the legal merits are potentially dubious. There's currently a case in Texas that was filed this winter, arguing that BlackRock, Vanguard, and State Street illegally conspired in violation of the Clayton Act to anti-competitively limit coal production in a specific region in the United States. So whether or not that case will be successful, time will tell. I think it's mostly a political issue, a very heated political issue in the United States. And these attacks are so political that, at least in the United States, it's hard to make, I think, sort of rational policy-based arguments in the face of the tone of the anti-ESG attacks in America right now. I really do think the antitrust suits are mainly a bullying tactic. But I would argue that the US should follow the lead of other countries in allowing for collaboration in this space. And particularly, I just want to point out, so antitrust law in the United States and in the EU, but primarily in the United States, over the past few decades has been interpreted to focus on the impacts to consumers. So the whole emphasis of the interpretation of antitrust law from the Chicago School and on through the 80s and 90s has been all about pricing in consumer markets. And if you raise consumer prices, that's an antitrust concern. And if you don't raise consumer prices, that's not an antitrust concern, sort of regardless of other concerns about the bigness of your market power, the size of your corporation or your collaboration. So long as you weren't hurting consumers, the legal argument was that it wasn't a problem. I'm oversimplifying a little bit, but so I would say if we define the product market for consumers as energy, as like the cost of energy rather than the cost of coal, for example, if we are really, when we think about policy and defining the product markets for consumer pricing, we should encourage collaboration that brings down total energy costs for consumers through renewables, even if it results in fossil supply limitations and eventually and over time an increase in fossil prices as we limit fossil production. So again, this goes back to sort of like the supply chain collaboration point, is if you're simultaneous, and this is an oversimplification because obviously different product markets and different fossil fuels are very sectoral specific, but in general, the idea that I'm going for is that if you're limiting demand simultaneously as you're limiting supply, it should raise less of the concerns about price spikes in the product market for consumers, meaning the idea is to sort of transition the entire economy, both on the supply side and the demand side, in line with one another. That should limit some of these antitrust concerns from a consumer perspective. And again, I think this is where the sector-specific decarbonization scenarios and the supply chain collaboration could play a really important role. Okay, and finally, the third critique of universal ownership is that there are agency costs and that they limit the ability of asset owners to force asset managers to do their bidding, including long-term portfolio impacts. And I largely agree with these critiques, actually. And I expect that we might see more splintering of asset managers into climate-friendly and not climate-friendly asset managers as asset owners start to make more aggressive demands on their asset manager clients or asset manager providers. In the US, we can see this divergence in what the red state pension funds and the blue state pension funds are demanding of their asset managers, in particular BlackRock. And BlackRock has tried to satisfy these diverging demands from, the Texas Pension Fund wants BlackRock to not be ESG at all, to stop making climate votes, to stop talking about climate change really at all. And the New York Pension Fund wants BlackRock to double down on climate initiatives, to implement climate votes pretty aggressively, to vote against directors for climate-related issues. And so BlackRock has tried to sort of please everyone by implementing its investor choice programs. Other investors call it pass-through voting programs, where they're curating their engagement with corporate directors and corporate managers to appease to what their asset owner clients would like them to do. I don't necessarily see this as satisfying asset owners in the long term, particularly because of the present political environment in the United States right now. So this Financial Times headline just came out, I guess, last week. Top UK pension fund pulls £28 billion from State Street over ESG retreat. I do think that the US asset managers are going to be caught in the crosshairs for the near future. And we might see more of an exodus from UK and European asset owners into maybe increasingly European and UK asset managers, given the pressure that State Street and BlackRock have received over ESG from the US politicians. Okay, and I actually just have one more slide. I think this is yet to be seen. There's a bunch, I mean, God, it's like such chaos in the United States right now. So in the US, recent political changes may really further limit the ability of asset managers to exert pressure on portfolio corporations. And there's several venues that this could take. One headline example has been the Securities and Exchange Commission has changed its interpretation of how 13D and 13D disclosure rules should be interpreted. So roughly what this means is that if you have institutional investors that have a large holding in a corporation, so own more than 5% of the shares of a corporation, if you can claim to be a passive investor that doesn't own more than 5% of the holdings because you're a hedge fund and you're trying to exert corporate control and sort of implement a takeover, you can argue, oh, I'm just a large passive institutional investor. I'm not trying to do a corporate takeover. I simply own more than 5% of the shares, but don't worry, I'm not trying to take over the company. You have a much less stringent disclosure rules than if you are, for example, a hedge fund that's trying to put in a new slate of directors or take over the company entirely. Very recent SEC interpretation suggests that actually, if institutional investors exert pressure on corporate directors to meet certain policy outcomes, particularly in the ESG space, that they will have to undergo much more extensive disclosure requirements than they have otherwise been required to in the past. In particular, the rules seem very targeted to me about, so BlackRock, one of the ways BlackRock has been engaging with corporations has been votes against directors, and they've been very public, and the numbers of directors that they voted against is actually quite impressive. It's a large number. That if they don't think a corporation has been adequately responding to climate risk disclosure demands or is not taking the transition seriously, they will vote against corporate directors. And the new interpretation of the 13D and 13G rule really goes after this sort of signaling of investor political intent through director elections. And I think it's really been targeted sort of specifically at trying to chill BlackRock's anti-director votes for climate reasons. And we've seen the reaction to this rule be very immediate. BlackRock and Vanguard immediately halted meetings with companies after the SEC cracked down on this rule. And the guidance has really thrown a lot of confusion into the mix. I think we'll see sort of a settling of exactly what these rule changes mean over time. There's bigger beyond climate, forget climate. It's just like a bit bizarre from a corporate governance perspective that you would pile all of these, there's 401k rules, there's rules in America that sort of encourage Americans and pension funds and asset owners to pile their money into BlackRock and Vanguard and State Street. It's very concerning that we then would not allow BlackRock, Vanguard, and State Street to have meetings with corporate directors at all. It just, I think, is very troubling that we'd create sort of a stock market environment in which there's not really anyone overseeing corporate directors or doing the steering that one would expect from your asset manager. Okay, so with that, I'm actually going to conclude. I know we had some questions that were submitted in advance of this talk, and I'm happy to answer those and also open it up to bigger questions. So Yusha and David, I will turn it over to you. Thank you for having me.
Thank you so much, Madison. Yes, thank you so much for the very interesting perspectives. I mean, as an academic myself, studying sustainable investment and business, but mostly from an accounting and finance perspective, it is quite interesting to hear you talk about the same issue that we study, but from the legal perspective on like disclosure rules, voting behavior, focusing more on the rulemaking process and the concerns from the political issues. So it's very, very kind of interesting to me. So we now transition to the Q&A discussion. Our moderator today is David Offrey, co-head of ESG and partner at Adolph Goddard or AG. So David is a leading ESG lawyer globally and was recognized as the Young ESG Lawyer of the Year in 2024, last year, by Legal ESG. He brought rich experience advising influential organizations in sustainable development, such as UN Global Compact, Task Force for Nature-Related Financial Disclosures, TNFD, that many of us care quite a lot about, Science-Based Targets Initiatives, SBTI, which is also studied quite a lot in the literature, as well as corporations and funds in climate transition, such as BMW, Shell, and Swiss Re. So we're very looking forward to David's reflection on Madison's lecture and helping us better understand the academic insights with experience from the field evidence. So David, over to you.
Thanks very much, Yusha. Hopefully you can all hear me. Doing a sound check real quick. Yep, saw the nod. Thank you. Madison, firstly, just thanks so much for running us through that. I love the fact that we went through the science before we got to the law. As someone who practices law, we often start at the law and then stay at the law. But before I turn the floor to some questions, perhaps a few reflections from my side over what's been said. I'm going to leave the comment at the end about everything happening in the States right now is a bit crazy and try and maybe give some perspective on the global reach as well. So starting at the top, really, I think it's one of the oldest conversations in the game has been what are the duties of fiduciaries and how do we actually manage them? And increasingly, I think the ESG conversation has forced open those doors. So we see in the UK, for example, we do have legislation that does at least encourage having regard to, under Section 172 of our Companies Act, some of the other stakeholders. We've seen examples in the Netherlands and other parts of the world where companies are actually changing their articles to increase the obligations for the boards to consider the long-term benefits. So that's a private initiative, but it's not being opposed by regulation. But fundamentally, laws still predominantly are focused on profit, and impact is finding its way there. And I think we're seeing a lot more of that in Europe than we are definitely in the States. And I want to go into some of the questions around how does one actually manage those fiduciary responsibilities and the imbalances when there is a lack of reg support in that. We can come back to that in just a second, because I think you had some interesting ideas there. The second one that I wanted to touch on was the demand side versus supply side, because I actually think it's quite a good contrast from a legal and reg perspective between the US and, let's take Europe as an immediate example. Europe's regulations is, even though Omnibus is still happening, and we're going to nod to that for a second, but despite Omnibus, the regulations have driven demand side. So they've driven behaviors of consumers. It's been a very consumer-focused market. Whereas the US, with laws such as the IRA, the Inflation Reduction Act, brought in immediate incentives from the supply side to try and drive up supply for a period of time. Again, whether that worked or not, and whether it's continuing to work, we shall see. But it's a very different approach to regulation, and I think the reality is that it's a combination for some of these that actually will drive that. But I do agree that demand does need to change, and that's probably a longer shift. We've seen cultural shifts take decades, if not more, and I think this is one of those. Where it's also interesting that you mentioned the variance between how antitrust laws are being managed, because I think something like ESG does require collective action, and the laws do require collaboration between organizations, and not just organizations, but organizations, academia, governments, and so forth, to get to a conclusion. There is a question around actually some of the initiatives and whether people are staying in or walking out, and we're going to probably touch on that in a little bit more detail in just a moment. But at least in the EU, the regulators did come out and say, actually, go for it. Have a chat with each other and see what can be done, as long as it's not market-sensitive information and not manipulate markets or consumer protections. So it's one that I do want to come back to again as part of that question, perhaps as well, as to why we see doing the right thing as an option when we're doing it together, versus what happens when you start to look at it as individual cases that start to force you to think just within your four boundary lines. And then finally, what I was quite keen on also re-emphasizing, really in support of what you said there, which is we've been working a lot of the economic models have been working on the basis of averages. There's a distance between localized risk versus what's actually happening internationally. And while at the same time we're trying to confront both problems, it's quite easy to go back up to a high level of climate, because math can math, right? You can calculate how much carbon, and you can calculate how to reduce it, and therefore it works. But when you look at things like water reduction and water risks, it's a very localized issue, one that can be obviously diluted, ignoring the pun on water, but diluted as you go up into global scale, but actually at a local level can have pretty substantial risks. And one of the things that comes to mind, and as part of my introduction, Swiss Re is mentioned there, but the insurers are quite conscious about the local real risks. And actually, when you start to think about it from a how's my business doing business in these environments, it may be a few stakeholders that need to be brought into this conversation, of which some are your longer term financiers, so the disconnect between asset managers and asset owners, by example, and your insurers, who are actually underwriting a lot of the financial risk that we're talking about here. So that's just a few thoughts from me, but I don't want to spend a lot of this time with me giving views on what's going on. I think there's some very interesting questions here. So perhaps we can start at a macro level, because I do want to take the bull by the horns on the recent events of this year, which have largely centered around the new presidency. And actually, I wouldn't limit it to that, but actually looking at the omnibus situation as well. How does ESG not so much remain relevant, but actually how do we start to really put into place measures, systems, processes, and perhaps even recommendations on guidance and rules to ensure that despite the political turmoil, the longer term success of businesses through an ESG lens are still assured or guaranteed? And just opening the floor to your thoughts, and of course, very happy to share rest of the world from my side as well.
Yeah, I mean, I wish that I had a solution to like the rise of global authoritarianism, and I don't. And I think, and I don't say that. I mean, I say that sort of glibly, but it does seem sort of like, at least in the United States, the amount that climate change has, I mean, like we're deleting our National Weather Service right now. Like we're deleting like huge swaths of NOAA, our main oceanographic agency, and where all the climate models are run. Not all of them, but some of them. I don't know what to do about that. Like that's not my skill set. I think that requires like political organization, that I will participate in as a citizen, but is like not necessarily what I like think of as, and my expertise as like an academic. But it does seem to be sort of like the most important, meaning like, I'll just be honest, like, I don't know what to write about right now. And meaning like my skill sets are often like writing about like recommendations for the Securities and Exchange Commission, and also writing about recommendations of like what the federal government can build in terms of like tools that will help investors better price physical climate risk. This time for like wonky lawyerly rational policy suggestions seems, I don't know. I mean, I think they're for a different time. So I'll say that. I think that being said, I think evaluating the impact of of Trump on ESG has to take at least two different analyses. One is like, what is going to be the effect of Trump on climate action? And I think that's TBD. It's obviously like not great, but I think one really big question in the United States is how much will Trump completely roll back the Inflation Reduction Act? Or how much is there actually a political constituency in the United States, including the red states, to leave the IRA's tax credits in place, which could actually keep propelling decarbonization of the heavy industries, the automobile industry included, because we've started to build EV factories in red states, for example. So one really big question that a lot of climate people have in mind is like, how much will the IRA be allowed to exist? Certainly certain grant funding that came through the IRA, so not the tax credits to private businesses, but grant funds that were sort of earmarked for decarbonizing households through sort of state level initiatives and nonprofits, that grant funding has been frozen. So some aspects of the IRA have already been limited. Whether courts will allow that grant funding to continue to be frozen is sort of TBD. I mean, so I'm very interested in sort of like what the red state political constituency, like what they will expect of the green transition going forward, and whether or not they sort of see the jobs that have been created through the IRA, and whether that will create a political constituency that will let the IRA endure. So that's bucket like one. The other bucket that I think is very concerning actually is the limitation of shareholder rights. And this is happening at a couple of levels, actually. I mean, so there's rules that are happening at the Securities and Exchange Commission. As I mentioned, the changes to the disclosure rules, which is certainly going to, I think, have a chilling effect on institutional engagement with corporates. There's also, I totally expect there to be a further limiting of the types of shareholder proposals that can be brought brought to a vote. So I think there's going to be much more of a limitation on whether you're allowed to bring climate related shareholder proposals like at all. I expect that to be a limitation. I think also really concerningly, and this might be less on people's radar, so I mention it, is that most US corporations are incorporated in the state of Delaware. And at this moment, there's proposed legislation in the state of Delaware that would also serve to like pretty significantly limit shareholder power vis-a-vis corporate boards, including things like books and records requests, and just sort of limit the ability of shareholders to police corporate controlling shareholders in particular. And the changes in Delaware are like not unrelated politically to the broader national political shift, meaning like the forces driving the proposed Delaware legislation are like similar to the forces behind DOGE, for example. All of which is very concerning, and I don't have a solution to it, actually. I mean, I think that you could see and I'll wrap up soon. I think you could see a future in which the largest blue state pension funds, so California and New York, but potentially also others like Maine and Rhode Island, you could see them maybe split away from the BlackRocks of the world and really concentrate their spending power in like a very climate branded and climate dedicated asset manager. I don't know if I'm not sure that public equities would necessarily then be like the best decarbonization path forward versus like CalPERS has like decarbonization solutions that they're pursuing through other types of asset classes, including private equities, meaning like just build a heat pump factory and don't try to do it through like the mechanisms of Delaware corporate law. So I don't know. Yeah.
So I'll share some of my mindsets as well, because I've had quite a few clients obviously on the phone or on this one recently saying, well, Trump's in power. I think there's a few things. When we saw Trump come to in his first term, there was actually a lot of corporates that took it on themselves to maintain their own internal policies that would sort of substitute for behaviors that weren't regulated for, especially those who are global. You may have come across the announcement that there was a suggestion that U.S. entities would not be allowed to comply with CSRD, even though that is a law. And from a lawyer's perspective, it's hard to say, please don't comply with law, no matter
Right.
the world. There are global standards that I think do still apply, including anti-bribery and corruption, things like that, which sit within the realm of ESG. I think climate is one that has become almost a scapegoat for the conversations around what other parts of governance need to be shifting. But actually, what we're increasingly seeing is that there are ways to manage this, internalized ways to manage this, but also we're hearing some horror stories where some companies are just saying, we'd like to hive off the US business because the US business is not working to the same standard as the rest of the world. And that comes from a realization, and goes really to your point on the presentation earlier, that the longer term risk for the business is actually a real risk from climate and from ESG. And that needs to be maintained and respected from a pure financial perspective. This sort of slides into the next conversation really about why people are stepping away. And it's quite interesting that the example used in the question there about BlackRock leaving the Net Zero Alliance, because BlackRock's also one of the few that just announced a whole decarbonization business. So it's also quite interesting that the different parts of the business are moving in different directions. I do take your point that there is a lot of activity still to be done and is taking place, just not being framed within the ESG banner. There are, however, some funds, especially European funds, SFDR-related funds, that have the ESG banner built into the fund structure itself. So there's sort of a variance here. But I'll share my experience first. So essentially, exits from the alliances have been taking place over the last couple of years. We've seen CA100 have the same reaction, the banking alliance have the same reaction, asset owners, asset managers. And some of these players, by the way, sit across multiple of the alliances. And so some of my clients who have exited have reasoned this on the basis of either we're doing too many bits of alliances and they're all slightly misaligned and just not fit for purpose. Two, there's been an opportunity for them to set forward their own personal ambitions and targets, which are, they believe, market leading and therefore industry-specific market leading and therefore more valuable than being part of the alliance. And third, really goes to your antitrust comment, which is that there's still some risk and concern that certain markets see that membership as a political or commercial risk rather than a legal risk to be part of. But really wanted to put it back to you as to whether you have views on why certain of these organizations are leaving, though I suspect your initial answer may have covered part of this already.
Yeah, I mean, I think it's, and again, like, I mean, I've read the complaint against BlackRock, Vanguard, and State Street, that the Attorney General of Texas, along with a bunch of other red states, have launched as an antitrust accusation. It is not a compelling complaint. Like, I don't think that it is. It's really hard to say what is going to be winnable in the United States at this point, given some of the political leanings of certain judges. So it's hard to predict the outcome of that case. But, you know, given that we still have to have a trial decision and there's an opportunity for appeal, I don't think, I mean, especially in the case of Vanguard, like Vanguard has not been, Vanguard has not been going around to coal producers and saying, like, don't produce coal. Like, that just hasn't been happening. And so I would expect that Vanguard should be fine. Actually, I mean, all of them should be fine. I don't think these institutional investors like have actually been behaving collusively in the coal market. I do think that given the state of politics in the United States, I think people are legitimately freaked out that these types of claims could be used as like a cudgel against them. I mean, I think the other thing, the one question is sort of the utility of these investor alliances. Like, maybe we don't necessarily need them, meaning like, we know that emissions have to go down as fast as possible. And you don't necessarily need an investor alliance to tell you that. And so maybe it's actually fine for these investor alliances to fracture and for these initiatives to sort of live on as just an initiative that's undertaken by the institution itself without sort of pledging collaboration with other institutions. I think sort of like an interesting question mark is then like, where does that leave the SBTIs of the world or these sort of sectoral scenario analyses tools? Like, will it be concerning to US regulators that everyone's using the same scenarios, for example? There was a time in which absolutely not. Like the IEA, the International Energy Agency, like everyone used those scenarios for decades. I could see it being potentially a legal claim that there's some sort of like spoke and wheel coordination going on through the use of like certain scenarios, but who knows what will happen.
Interesting you mentioned that, and we'll go straight to disputes from this one actually, because when I've done a couple of the large disputes in Europe on green claims, greenwashing, in fact, without naming names here, some of them were some of the first that hit the market. And actually, what was quite interesting was the IPCC reports had been published back then, and they were used as sort of the global standard on data. And it actually shifted the onus onto the private markets to say, well, why is your data slightly different? And then they would rely on other alliances or frameworks to say, well, we followed this and this and this. We're seeing a tendency now towards greater homogeneity, I would say. Like your TCFDs are incorporated into ISSB, into IFRS and ISSB are becoming your globally accepted standards, with CSRD and Omnibus being diluted slightly. Probably going to find ourselves getting even closer to that point. But it has been used in courts, and there will be claims made about whether certain analyses, certain models are actually legitimate models, or whether they were paid for or funded by how they came into existence, and whether they're facilitating certain behaviors in the market. From a pure legal perspective, of course, it comes down to, did you rely on something that is within your industry specific and accessible and generally adopted? Were you fair? Did it make sense for you to fairly and clearly follow this? And how are you verifying your information that you're publishing on your disclosures as against that? That typically does apply to the larger corporations, but I think increasingly we're seeing that flow through activity through the value chain anyway to try and get access to this information, and therefore it's one's driving the other. And I push the conversation in this direction for two reasons. One is I want to go back to the Delaware case, the Zuck case. Because an interesting comment was made in the Q&A today, which is there not a silver lining in the Zuck case? And actually, it does start to go towards, and it's a long paragraph, so I'm not going to read it out, but it starts to go towards the question on, does this not encourage directors to start to think about the longer-term benefits and risks, frankly, to their businesses? From a European perspective, looking at things like CSRD, that's really what it was forcing out. It was forcing out impact, risk from the business, putting it in your annual reports, publishing it centrally, tying it into value chain, and putting it out there. But I suppose the question going back to the States versus rest of the world in terms of some of these aspects, do you see any silver linings, not just from the Zuck case, but generally silver linings in terms of how the behaviors from the policy and regulation side are driving opportunities for the financial markets to start to really engage with this in a way that aligns with economic models of old, frankly?
Yeah, I mean, I'm not sure that's the silver lining necessarily of the Zuck case, in the sense that, like, I think that was just, like, always Delaware. That's what the law of Delaware said, that, like, you could always, as a corporate director, consider stakeholders for the purpose of the long-term value of your corporation. And I think that there's an argument for that being like what Microsoft is doing. Like I think of Microsoft as an example because they are spending a significant amount of money on carbon capture. And I think it's for a variety of reasons. One, it's like certainly branding. So they can make an argument like, we just like want to look good and we want people to buy our software. So we're going to try to have like stick to our net zero goal. But I think also like legitimately, I think you can't sell software in like a Mad Max world. And I think that Microsoft sort of knows that, and that like it is actually in the long-term interest of Microsoft as a corporation for us to do something about climate change. And unfortunately, I think connecting those dots is like still not obvious to many actors in this space, but I think that that's like totally defensible under Delaware law from a director perspective, like from a director's understanding of like what they are doing in the world to pursue decarbonization goals, like absolutely. So I don't see the Zuckerberg case as foreclosing this type of climate action like at all, actually.
So I'm going to push this a little bit further because I agree with that comment. And I'm going to go to how do we get there? So how do we get to a point where it makes sense for the directors to be thinking about ESG? So let's talk about financial returns on some of this stuff. We saw last year Temasek GIC announced some really good profits coming out of their funds on climate. We've seen more recently stronger returns, I should say, from investments into the transition. In fact, one thing I often say to my clients is, if the entire planet's in transition, you ought to be making money. And that's just it, right? We're at a crux right now, which is that you could probably invest into most sectors and try and find an opportunity within transition, as long as the financial modeling starts to make sense. So one of the questions that's actually been put forward, which I'll put to you as well, I have my own views, but I'll let you go first on this one, which is that in order for us to, so it says, it's good to believe in the green line. So this is going to your graph, the comment there, on the net zero pathway, but does that not necessarily put capital behind those that need most hard to abate sectors, basically? So should we be funding or pumping more money into the hard to abate sectors in order to achieve net zero, or should we be taking the approach of, oh, coal is bad, we can't touch it? And I think that's really what the question is trying to get at, is how does capital get deployed to finance a transition that then allows us to achieve some of the pathways we're defining, and probably in a way that makes money?
So the question is, like, if you have to make a choice between funding green steel, or what's the question? Like, if you have to put a choice towards divesting from coal or funding green steel, what would you do? I mean, it seems like you could do both.
I'm going to make it more specific. So let's go with this scenario. So we can say, let's bucket into two. So one is, you're investing for impact, you're not investing for profit. How do you defend that to you? And you're showing the money by putting it into an industry that may not be there yet, but may be growing. So let's call it a growth industry, but it needs a little bit more for horizon. Or you put money into what's making money. So coal is a good example where money is being made with commodities more generally, the fossil commodities. And actually, the result of that is that you then have a very large fossil portfolio, which doesn't look good from an impact perspective. And I suppose the underlying question on both of this is, if we're going to achieve net zero, should we be putting a lot of capital into the hard to abate sectors to help them transition? And I think we both have a similar answer on this, and I think both is the right place to go. But taking each bucket one and by one, what are your views on those?
I think, yeah, we need to be putting a lot of money into the hard to abate industries, and that's going to give us like a lot of bang for our buck long term. I mean, so again, I like go back to one of the biggest problems right now, I think, is like, I think that if you are in charge of managing an endowment, for example, you should be thinking about what 2050 and 2060 looks like. And I think, and this is going to be controversial, I think that could even mean taking a haircut in the near term, meaning making slightly less money now, in order to make sure that your university is not underwater. Like, I think that that is like the type of perspective we should be adopting. I don't think that's really where the market is at all. But I think that investing, particularly in like home decarbonization, heavy industry decarbonization, electric vehicles, I think, and like grid transitioning, I think that is where people should be spending their efforts. You know, again, this is where I get to the demand side. Like, it does feel a bit for naught if all of a sudden, you know, AI is going to require 5 times the amount of electricity demand as what we need. Okay, I'll just say one thing on the AI stuff. I thought what was so fascinating, and this gets to sort of what I think, doubling down on this portfolio perspective, when the DeepSeek model was revealed, and it was like so much more, allegedly so much more efficient than the leading OpenAI model and Anthropic models. Like, not only did NVIDIA's stock really take a hit, meaning all of a sudden people were like, oh, the American AI models, like maybe they actually like, they're using like so much electricity like and energy unnecessarily, like maybe actually there's a way to do, there's a way to have AI models be like much more efficient. Not only did NVIDIA's stock decline, but like some of the major energy suppliers in the United States stock declined, meaning like all of a sudden demand projections for energy were hurt by this one Chinese AI model being so efficient. I don't think, you know, I think there's been more work coming out about how like actually maybe over the life of the DeepSeek model, it actually is very energy intensive. And so that was a sort of overreaction by the markets. But like, that is not to be ignored. The fact that like one AI model could impact like energy stocks in America, including like Midwest region, like specific electricity suppliers, like that really does show, one, the portfolio-wide perspective that I think you should be adopting, meaning like you should be aware of like how some certain demand in your portfolio is really impacting like supply requirements in your portfolio. But also I think I think that, I'll just say one more thing. I think that all emissions are not the same. And, I have a bias here where I think that emissions used for growing food are like better than emissions used for like making AI art. And we should think about that as we like think about the future of the economy, about like what are beneficial uses of the limited energy supply, green energy supply that we have.
Yeah, I'm not going to comment in case there are any artists here who are seriously offended by that one statement. No, I'm joking. But I do think, look, we're dealing with the same conversation in the real world as we are in the digital world, right? There's limited resource, and we need to figure out how we're going to use it in the right way. That said, I do want to just take one last question before we are going to be forced to wrap up on time, which is actually, can we talk for a second just about the smaller medium companies in this conversation? Because I know everything we've talked about right now will likely tend towards the larger companies and the leverage they have. But how does a smaller company, or let's create an asset owner, by example, how does an asset owner in this environment, in this market, leverage its position? What are some of the specifics we can offer by way of stewardship to an asset owner in the SME space?
So I don't think we're quite there yet in terms of like acceptance of this as a way forward. But I think I'll say a few things. There was a time back in the day where pension funds were just much more locally focused. Like corporate pension funds would focus on investing in the community more. They would invest in like the muni bonds of the community in which the corporate pension fund was located. They would invest in building bridges and making sure the hospital was functioning, like within Rochester, New York, where like the Kodak pension fund was. And now we're in this like very exploded globalized market in which like you are expected to be able to reap returns like wherever they possibly are highest, like no matter where in the world, what asset class they may be. I think that we are headed for a time of like extreme disruption, both like geopolitically, but also again, to double down on the physical impacts. Like I think that in 10 years, things are going to look like even dicier than they do now. You're going to see LA-style wildfires happening more frequently, and Helene-style cyclones happening more frequently, and extreme flooding like in Spain happening more frequently. And I think it is worth it for pension funds to think about where they can make a reasonable return, helping their own constituents like be safe. And I think investing in green housing in a domestic space, investing in adaptation measures in your domestic community, I think that, and I don't think we're there yet, but I think in 10 years that could be I think the world could be sort of ready for thinking more locally about how to make your own state or country's retirees just like physically safer.
And I'll just add one last comment on that before we hand over. I'm going to come back to you for one takeaway, so one 30-second takeaway in just a second. But the UK, for example, invests a very small proportion of its pension money back into the country, whereas Canada looks at like 14%, something fancy like that. And actually, that is the difference. It is about how much goes into the real economy. There are states trying to regulate for mandating investment back into the domestic economy for adaptation, which is a whole different set of issues. But we are starting to see that with climate disasters becoming more and more real from a sovereign perspective, we're likely to also see more regulation driving those behaviors. And so it's probably one to get ahead of the curve on if you are in that space. So my last takeaway before I hand to you, Madison, for the final word on this, is think global. Don't worry, the Americas are the Americas, but there's a lot of other things happening out there. I genuinely think that sustainability has some way to go. It's going to get worse before it gets better, and it's going to take a little bit of courage. So if you are trying to do something new and wacky, you're not the only one, and therefore you should probably be brave enough to go for it. And Madison, over to you before we hand back to Yusha and the team.
I'll just say this is a bit orthogonal even to our entire discussion, but it's a thing that I just really want to, whenever I have an opportunity, I want to make sure people like remember and realize it, is that The people in the financial industry that we have tasked with understanding physical risk and weather risk and extreme events are the insurance sector. And insurance prices risk on a 1-year time horizon. And this duration mismatch between like the people who are really good at pricing weather risk have a 1-year time horizon, and the people lending to, you know, the asset classes like mortgages in America are 30-year mortgages. There's a skill set mismatch, which we have not even begun to scratch the surface of trying to amend. And so the fact that the banks do not hire people who know about hydrological risk or weather risk or extreme events, I think it's like a ticking time bomb, actually. And that if you are investing in a long-term asset, including like a 30-year mortgage or even like a 10-year bond, you should be thinking about the skill sets you need to really assess the risk of that asset, which includes science. And I don't think we're really there yet, which is a thing I would like everyone to consider.
Yeah, great. Thank you. With that, Yusha, Zoe, back to you. And thank you for everyone's questions.
Thank you so much.
Yeah, thank you so much, David and Madison, for this very interesting and informative discussion. So, by the way, I share Madison's opinion that the emissions from growing food is better than emissions from AI art. So I agree with that. So it's a lot of food for thought, and I definitely learned a lot. And so I hope our audience have the same feeling. So thank you very much for both of you for the sharing. So to our audience, thank you so much for being part of the third lecture of the NBS-PRI-ECGI public lecture series. We're so grateful for your presence and engagement and for your very interesting questions today, and hope you gain valuable insights and have inspired and are also inspired to further explore this area. So a heartfelt thank you also for our dedicated organization committee from NBS, PRI, and ECGI around the world for your great work and dedication in the smooth operation for this series. Just a preview, our next lecture will be on April the 17th in hybrid mode. So for those who are in Singapore, please come to our beautiful award-winning building, Gaia, at Nanyang Business School, NTU in Singapore, to join us in person. We'll have refreshments and networking opportunities before the event. But of course, we'll have live stream via Zoom for our global community. And for this time, we'll be studying sustainable business from another perspective in strategy and leadership. So this lecture will be delivered by Professor Rodolphe Durand from HEC Paris on double materiality, underlying ethical principles for investing and performance. And it will be moderated by Kenneth Ho from Seatown Holdings, which is the signatory of PRI in Singapore. So please note on the date and the time in your calendar. We look forward to welcoming you again next month, either in person or online via Zoom next month. So please stay tuned for our updates from our emails, website, and social media. So before you leave this virtual room, please take a few minutes to fill out the feedback poll on Zoom. We appreciate your honest feedback to continuously improve our series. So this marks the end of our event today. Thank you once again, and hope you have a wonderful rest of the day.